There's a few things. The first is the bond market, if you look at it, in terms of what it's pricing in terms of monetary tightening and inflation expectations, you could say it's priced for perfection. Yields have risen a lot in the past year. So the bond market is better value than it was a year ago, and it provides a better hedge in portfolios than it did a year ago. Because if something goes wrong to threaten the economic outlook, all of that monetary tightening has to be unwound. And as it does, the bond market would provide a better hedge if there is a shock. The most important one is that inflation generally is a positive for equity markets, and because it's a positive for earnings growth. And we see it when we look at history. When inflation rises and when inflation expectations rise with it, profit margins also improve, earnings also improve, and that goes with equity market performance. Equity market performance is strong. Now, there is a point at which inflation can overshoot and then become a bit more disorderly and disruptive, but we're not near that point yet. It is more likely, and it's what we expect, is inflation will be moderate. It has picked up a lot more quickly than many expected, but it's a positive for equity markets. Another way to think about it is if you were to go back 12 months ago and had a crystal ball, but it was a faulty crystal ball, and it only was able to tell you what inflation would report, but it wasn't able to tell you anything about financial markets, what would it say? You would see that in the US inflation would be 4 to 5%, and in Australia inflation would surprise on the upside. So you might be concerned by looking at that as to what financial markets would do. But actually, it would surprise many to realize that actually gold would not have provided a good hedge at all during this period, but equity markets, being fully invested in equity markets, would have been the best decision that you could have done. So we have a small overweight in equities at the moment because we think that earnings growth might lose a little bit of momentum, but still will be underpinned by the economic recovery. In terms of the global fixed income market, we like to allocate to the broad opportunity, to take advantage of the broad opportunity set. So not just Australian fixed income, also global high yield, emerging market bonds. There's a strong argument for being diversified within fixed income on a strategic basis. Within the Australian fixed income market, in the recent period, we have not liked the very short end of the curve, but having seen the big sell-off in that part of the curve, we see more value there than we did before. But we still think that the curve will steepen, so we are staying away from the very long end of the curve. But definitely, bonds do provide a better hedge. If there is a shock, they have a better hedge value than they did 12 months ago.